You're going to learn about three topics today: the dollar, inflation, and sovereign bonds. And it's all to help you better understand your finances, your economy, politics, and society. My name is Emil Kalinowski. I'm your host, and this is Making Sense, a Eurodollar University production. I am joined by a man that Real Clear Markets refers to as the head of global research for Alhambra Investments. But out on the street, he's better known as the sleuth of the shadows, the man that peers into the monetary nooks and crannies to tell us how the monetary order is functioning or malfunctioning. Jeff Snyder, good morning.
Good morning. I think I'm a guy who has too much time on his hands and spends way too much time reading arcane economic history and literature. That's probably a better description of what I do.
But that's not going to make it, that's not going to sell the YouTube or the podcast show. We got to stylize you as some sort of a cross between Sherlock Holmes and Magnum PI.
Well, then you have my sympathy because that's a very tall task.
Grow a mustache, get a Ferrari, unbutton your shirt, a couple more buttons, and wear the hat.
I'll have to move to Hawaii too, so that's probably a longer-term issue.
Maybe you can join George and Hugh down in St. Bart's. So
there you go.
Shout out to them if they're watching. Jeff, we're losing viewers because nobody's interested in our banter. Let's turn to the dollar. This is probably the number one question I receive on Twitter, and that's other than whether or not I really did apply lotion to wealthy ladies in the Cayman Islands for tips. It deals with the dollar. Number one, on July 27th, you posted at Alhambra Investments an article whose title echoes Spartacus and Eminem. Quote, "Would the real dollar please stand up?" Was there anything specific that inspired you to pen this article?
Yeah, DXY. Essentially the idea that the dollar is absolutely crashing. Everybody has been saying for a very long time, which is important to note that they've been saying this for a very long time, that the dollar is history. It's toast. It's had its run. It's had its day, but it's finally over. We can have the funerals now. It's going to happen. DXY broke below its supposedly multi-year trend, which means something to somebody somewhere, and therefore, sorry, American citizens, but the U.S. dollar is no longer a valid currency, and it's on its way to zero.
We're going to talk about that. We're going to talk about DXY versus the dollar and everyone's opinion. But let's start with December 3rd, 2015. Now, Jeff, I remember that day because I was actually at Lambeau Field. It was a night game. Green Bay Packers were hosting the hapless Detroit Lions. It was snowing. Detroit put up a good effort in the first half. Thereafter, of course, they lost because they're the Detroit Lions. What else happened that day?
Well, while you were having fun going to the game in Green Bay, I was reading the ECB statements about what they were supposedly doing that was going to help the European and therefore the global economy get out of this funk that nobody could seem to explain. And, the way it was told was, hey, the ECB is going to do a lot more with QE. They're going to really hammer negative interest rates. They're going to do all of these things that were told as accommodative, but yet they disappointed the markets by only doing, they extended their QE a little bit further out in time, which is kind of what always happens to QE. And in terms of negative rates, they only dropped the deposit floor another 10 basis points to, I believe it was minus 30 basis points at the time. But what happened was, in terms of the currency, from that point onward, the euro, which had been kind of sideways to weaker from that before then, started to rise again, which was kind of the signal or kind of the indication that you could take it, because the dollar is lower against the euro when it goes up, that this was a good thing, that maybe the ECB hadn't disappointed, at least as far as the euro was concerned. Maybe there was some positive stuff to take from this. And the euro started to rally for, I think that lasted 4, 5, 6 months.
Yeah, it rallied twice, actually, in 2015. Okay, so it rallied, despite the fact, as you said, March 2015 to February 16 were some of the worst economic, financial, monetary conditions since 2008, or actually since 2011 in Europe's case. Did we see anything in either of those? Let's start with 2008. Was there anything similar with the euro rallying despite a disorder?
Yeah, in late 2008, I believe it was October, late October, with all of the banking crisis going on. We've got stuff going on all around. Central banks all doing crazy things that no central bank had done before in Europe, in the U.S., all over the world. It was a crazy period, and all of a sudden the euro stabilizes, then starts to spike higher during all of this mess. And so it was, again, it was, hey, this rising dollar stuff going on, which is the financial chaos that we've become way too familiar with because it keeps happening, that goes along with the dollar going higher. But yet here we have this key currency cross, or what we're told is a key currency cross between the US dollar and the euro, like 2015-16. In October, November, and early December of 2008, it surged. The euro went, almost skyrocketed. It was like, to some people, it was a signal that, hey, the global financial crisis in 2008 was over. They had finally solved it. They whatever the right combination of magic programs was, they hit upon it somewhere around October 2008. And for a couple of weeks or a couple months, not quite 2 months, it really seemed, if you paid attention to the euro against the dollar and made that big part of your analysis, it seemed like, hey, maybe they had actually done it. The dollar had switched. The euro was going higher. Maybe this was the end of the crisis.
So that's two examples now. We've got 2015, 2008. The euro is rallying. And in both cases, right, it was rallying not at the end of the disorder. That's the point you make in your article. It was rallying with many more months of disorder and upheaval remaining. What about the big one for Europe, 2011 to 2012? Same example?
Similar example, yeah. And I think you're right. We need to point out and emphasize that this was a false signal. The euro rallying at these times didn't really tell us much or anything other than the fact that the euro was rallying against the dollar. It had very little to say about the global dollar system and the conditions in the global dollar system that had been moving the dollar higher beforehand. And then again, we're getting back to the discussion of DXY. DXY isn't really a dollar index, it's a euro index. I mean, it doesn't measure the euro, it measures the euro against the dollar. But when the euro is the main point of emphasis, the largest weighting in the index, therefore it's moved around by the euro, what we're saying is that it can send these false signals from time to time. And another one was 2011, 2012. The euro had been weakening, the dollar rising against it. And then all of a sudden in July of 2012, Mario Draghi made his famous promise that the ECB would do whatever it took to save the euro. Well, as far as US dollar euro currency investors were concerned, they believed him. Because from that point forward, July of 2012, the euro began to rally yet again. So the dollar lower against the euro up. But from July 2012 until early 2013, the recession in Europe only got worse. And we came close to experiencing one in the United States, which is why in September 2012, Ben Bernanke unleashed his third and then December his fourth QE. So again, we have this false signal of the euro rallying against the dollar, which doesn't really tell us much about the dollar. It tells us more about what people are thinking dollar versus euro, which doesn't apply universally to the dollar system.
And for our audience who is paying attention closely, some of you may have just slipped off your chair when you heard Jeff say that Ben Bernanke did a third and then a fourth QE. Now, in popular culture and the business press, only the first three are acknowledged officially. But in previous episodes, we've talked about that just because the Fed doesn't say there's a fourth QE doesn't mean there wasn't one. Great example last September 2019. But go back and listen to our other shows. So Jeff, we've got tic-tac-toe, 2008, 2011, 2015, the euro rallying despite many more months of disorder. What about, can we make it a connect four? This is the fourth euro-dollar disorder. Are we seeing that same thing taking place right now?
Yeah, the euro has absolutely spiked against the dollar, going back to the reopening in the middle of May. So what you see is the euro going way up and joined by the Japanese yen, which is a contrary signal. So those two currencies were basically most of the DXY index. So the DXY index has been dropping rather steadily. I think it's down to around 93 as we currently speak. So for most people who have been waiting for the dollar crash and predicting the dollar crash and forecasting, telling you get ready for the dollar to crash, all of these times, what they're really saying is the euro, the euro, the euro. And that's why, as they keep predicting the dollar crash, every time they do predict a dollar crash, the dollar is actually higher than the last time they made their prediction because they're following all of these wrong signals. The euro is not the dollar. The euro is certainly not the euro dollar, which is what we talk about, which is what really moves the dollar. When you look at the dollar outside of DXY and its heavy association to the euro and the false signals the euro tends to send at these particular times, the dollar has barely budged from its March 2020 highs, which tells you a very, very different story than, oh my God, the dollar is crashing.
Let me explain it a little bit more detail for some of us that may not be following exactly the difference between the DXY and the dollar, the broad dollar. So the DXY is a dollar index that's most commonly referred to. I think that's because it's used by currency traders, and I think it's because it's actually tradable. It's maintained by the Intercontinental Exchange, ICE, and it weights only 6 currencies. So, dear audience, when you're listening and you're thinking the dollar is falling, you're thinking it's falling against everyone. Well, no, it's just 6 currencies. But as Jeff has been saying, the weighting really makes it just the euro. So it's the euro, the yen, the pound, the loonie, Canada, the Riksdollar, Sweden, and the Swissy, Switzerland. But the euro is 58% of the weighting, and the yen another 14%. The pound brings it up to 12%. Doesn't bring it up to, but that's 12% weighting for the pound. Jeff, a moment ago, you said something that might be interesting, might be confusing as well. You said that the rising yen signifies a disorder, like a rising dollar.
Yeah, it's kind of backwards in our convention because the rising dollar is global dollar shortage, falling dollar is more plentiful dollar resources on the euro dollar markets, but the yen is actually backwards. When the yen goes up against the dollar, therefore the dollar down, that's consistent with shortage because Japanese banks in Tokyo are a primary redistribution point for dollar resources, especially into China and the rest of Asia. So when the yen goes up, that's not the same as the euro going up. In fact, it's actually the opposite. When we see the yen spiking, that always, not always, but in most cases, that associates with some of the worst financial conditions, including March. When the yen surged in March, that was a bad sign. So yen going up along with the euro is kind of a contradictory signal, but except that we realize that when the euro goes up at these times, it doesn't really tell us anything. So the yen going up is actually the only thing you really should pay attention to, and it's conflicting with the idea that the dollar is crashing. So the yen up, euro up, one doesn't really matter, the other one does, but it matters in the other direction. So DXY is simply a total mess at this point, sending you the very false impression that the dollar is crashing when, a good part of it is saying, no, we're still stuck in the same mess. And then the other part of it is the euro, which is, strike 4.
Strike 4. I think it's Yahtzee once you get to strike 4.
Oh, is it? Okay, Yahtzee.
Jeff, I don't know if you knew this, but on Tuesday on the financial tabloids, was a title that was full of heavy breathing. And Zero Hedge let it be known that the venerable and august investment bank Goldman Sachs had put out a piece where they noted the increase in the euro, the yen, the Swiss, and gold against the dollar, as well as the usual commentary about geopolitical tensions and the Federal Reserve leaning towards an inflationary bias, that all means, quote, real concerns about the longevity of the US dollar as a reserve currency have started to emerge, end quote. Jeff, have those concerns emerged where you're sitting?
How many times have we heard this? I mean, I'm pretty much I tune it out nowadays because it happens all the time. Every time the DXY index starts a little bit lower, we hear the same thing. Again, as I said before, they keep predicting the dollar is going to crash, and then you look around, the dollar index, even DXY, is higher than the last time they made the same damn prediction. And eventually, you have to say, why aren't they getting this right? What are they missing? And it gets back to one of our major thesis around here, which is it doesn't seem to me as if people understand what a global reserve currency is, what it takes to be a global reserve currency, and therefore how incredibly, almost impossibly difficult it is to just simply replace it. The dollar is not going anywhere, not because it's a good currency or that it's acting the way it should. Quite the contrary, actually. It's a mess and causing all our problems, which again makes my point. If we have this dysfunctional currency system, why haven't we replaced it? One reason is nobody knows what's going on, but the other thing is it's not so easily replaced. It's not something you can just snap your fingers and say, we're going to start using gold or gold-backed crypto or SDRs or Chinese yuan in a basket with Swiss francs and some Norwegian kroner. I mean, you can't just do those kinds of things. There has to be a very deep, sophisticated, developed infrastructure that trades in these currencies, the banking system. That's why it's a bank-centered system. If that's not in place, if that doesn't exist, then this is all just worthless conjecture, as it's shown to be time and time again. Every time we hear the dollar's crashing, it's going to zero, and yet a couple months later, a couple years later, it ends up being higher, not lower.
And so for dear audience, if you wanted to see exactly what we're referring to when we say it's higher, yeah, the DXY, but you can go to Google and you can Google Fred, and then you look for broadly traded goods and services dollar. And what you'll see is that the US dollar, when it's weighted against all of America's trading partners, is really never came off the boil. It did come off the boil, but it's still higher than where we started in February. Jeff, last question from me. You've explained why the DXY is sending conflicting signals. You've suggested people turn to a broadly weighted dollar to measure. But you end your article saying that you're not a zealot on this. In so many words, you've said this, that if the dollar starts going down, you'll be happy to note that that's what's taking place, and that you said you would need corroboration from other markets. Can you tell the audience which other market were you thinking of, and what is that market saying right now?
Well, it would be the money curves, the U.S. Treasury curve, global bond markets, gold, all these other potentially corroborating markets and signals and indications that would say, yes, something significant has really changed. Something has become positive, or if you're Jay Powell, inflationary, whatever. The current background deflationary global dollar shortage squeeze, however you want to call it, euro dollar squeeze, that has finally given up and moved on into something else. The banking system has moved on into something else. And we just don't see any signs of that, including, as you just pointed out, Emil, a broader picture of the dollar when it's not so heavily influenced by the euro has barely budged from the March. Yeah, it's down since mid-May when the economic reopening happening, but it's not really down that much, and certainly not down in a way that would make you think that it's about to crash, or that Jay Powell has printed so much money that he's destroying the dollar as he's really trying to, as he's intending to do. We just don't see that. It's just not there. There's no evidence. And by the way, this higher dollar, this broad trade-weighted look at the dollar, or if you want to look at it as individual currencies, they will show you the same thing. Those are consistent with the bond market, lower yields, lower real yields that are, sporting new records in some places that are telling you, nah, there's nothing good here. And nothing good here is typically bad for the banking system, bad for risk-taking, therefore bad for the monetary system, and therefore rising dollar potential.
Jeff, this is Eurodollar University, and you're playing the role of Mr. Chips, the professor. I'm the teacher's assistant, but the audience has questions. So, dear audience, if you have questions, go to YouTube, ask them in the comments section. Go to Twitter and ask them on Twitter. I'll do my best to respond. If I don't respond, that hasn't meant I haven't read it. In fact, I have read it, and it'll help steer the show. You can reach Jeff at JeffSnyder_AIP and me at Emil Kalinowski.